That was great. I'm really excited to announce the next panel. We're going to take a look at kind of the private investor market and how private investors can successfully invest in shipping. We all know that shipping has a lot of strengths and also some challenges, and we're going to sort of talk about what the elements of success are today. So it's a pleasure to introduce John Bradley. I think everyone probably knows John. He's a shareholder at Vedder, part of the Marine Transportation Group. And John, take it away.
Right, man. Good to see you. All right, Matt. First, I want to congratulate you and Mike and Lorraine and your team for getting this gang back together. The downside of that for me is how to get out of my loungewear and try on stuff. The pandemic's been very good to me. So I'm happy to be here, as I'm sure all our guys are. So we are in this panel called GPs and LPs, something about which our panelists are well versed. I'd like to introduce each of them and then ask briefly, ask each of them then to just tell us a little something about their firms. The guy sitting to the right of Bob is Jake Scott. True. Jake is a managing partner, current of FDX Offshore, which he formed in 2012, according to these notes. Jake and FDX has provided over $500 million in financing for maritime projects, ranging from brownwater tugs, barges to VLCCs, offshore drill rigs, and LNG. Comes from a big shipping family, so I understand it. Okay, Darrell, to the right of Jake. Darrell is the chairman and managing principal of Easterly Investment Partners, which he founded in 2009. The current CEO of Maritime Logistics Equity Partners, which Easterly formed last September. We'll hear about a little bit more about that later. He's also serves as the chairman of the board of directors of Easterly Government Properties, an NYSE listed company. And prior to founding Easterly, he did a lot of things. Shaun, where's Shaun? Shaun is at the end. Shaun is the co-chief investment officer, Global Transportation Infrastructure of the Mount Street Group in London. Welcome back over. He's done that since February 2020. Before that, many of you probably know Shaun because he was with JP Morgan Asset Management, where he was the executive director for Global Transportation and Alternative Investments Group, and actually helped build that group into one of the largest institutional ship owners in the world. That's too much to read.
All right, everyone knows Bob. Bob is the chief executive officer of Ridgebury Tankers. Has been there since 2011. Bob's done a lot of things, all in shipping. Now, I would ask each of you, because we're in the context of what we're talking about, starting with Darrell and moving down, or starting with Shaun moving down, tell us a little about your current firms and how they fit into the world of GPs and LPs.
Sure, thank you. So Mount Street Group, so we have around 85 billion of assets under management. That's predominantly within the loan servicing, structured credit, and then more recently within direct investments within transportation. So early last year, we launched an investment platform focused on transportation and infrastructure. And we have deployed capital now successfully within the shipping space. A number of assets, initially on containers, but now focused across dry bulk, tankers, and gas.
Darrell.
Yeah, at Easterly, we are a $5 billion platform that invests in many different ways across equity. We put about $500 million to work specifically in GPLP structures around different different dislocations that we've seen in various markets, from real estate to healthcare. And most recently in September, we organized a fund around shipping, given the current dislocation in the market. And we can talk a little bit about how that all comes together and the needs of investors. But principally, that money's been put to work, and we've launched a second fund that is to again continue to take advantage of the current dislocation in the market.
Great, Jake.
So FTX is set up as a maritime merchant bank. We're actually backed by a family office here in New York, and set up to introduce family offices to maritime-related investments. One of our key investments is Walmart USA. We're a 40-ship chemical tanker pool.
Hi. First of all, shipping is always dislocated. So that's all right. I was sitting in the audience and I was looking at this thing up here that said, getting the band back together. And just wondering how many people know what that means. And looking around the age group, it's from the Blues Brothers in 1980. Jake and all the blues.
Well, I did know that.
I'm sure you did that. Ridgebury Tankers is a private equity sponsored platform. I think we have 6 different PE investors, and we have investments in LCC, Suezmax, and MRs. We have invested in Afras in the past. We're always in tankers. That's what we've done historically. And we've invested with, I guess, a few people in this room. Thanks.
All right. We heard a little bit this morning about the availability of capital in debt markets and capital markets as alternative investments since 2008. I mean, where are we now for each of you guys in terms of availability of capital for shipping, and what types of opportunities is capital looking for in the shipping space? Bob?
Some of the there's a lot of capital out there, which you can really say for shipping. I think it's driven by the container ship boom and the dry boom. And of course, tankers aren't there. The tanker assets have a strange dynamic right now. The asset prices are up. Charter rates are horrible. That means one has to correct. So we're questioning whether that means that the entire price structure has gone up because of steel and scrap prices and new build prices, or if the market's wrong and the asset prices come down, or if a lot of the upcoming, what we hope for and believe, increase in charter rates will move up into the asset prices. So it's a dynamic where an investor has to believe that the future is bright in the next 6 months. And everything that we've seen as far as supply and demand, stock drawdowns, looks like it will take place. But it's one of those things that we thought would happen already. So you start to doubt yourself, well, it hasn't happened already. Does that mean I was wrong? Or was I just slightly wrong on the timing? And it seems like it's the latter. A lot of the newer investors in the sector, they want to see current income and asset appreciation, which tends to be difficult in this market. You can't buy an asset today and lock it in at a time charter rate with a decent current return and still have a lot of upside. So it's a combination of talking to investors who are new in the sector, and then the experienced investors do look at it as an opportunity right now.
I mean, for us, one of the reasons we're here is we're seeing a massive shift, into hard assets, and shipping is perfectly positioned, to be a beneficiary of that tailwind. I mean, we see investors who are patient and are looking at a 36, 72 month kind of time frame. And today, as you look at charter rates, we're very confident as the world demand grows, the opportunity for those charter rates to rise will happen, and we find capital to be very patient and excited to be invested in a hard asset opportunity.
Yeah, Jake, sit here. I need to say
Jake, what about family offices?
So family offices tend to act a lot like private equity. They're used to investing in private equity-like structures, and they're looking for private equity-like returns. And they're looking for partners to help them put that capital to work. And many times they'll actually even partner with a private equity firm to give them some advantages, because the hardest part is getting the equity, and shipping is very esoteric. It's not aircraft, it's not real estate. There are dynamics that family offices don't have the experience in, but they still want the hard asset exposure. And so partnering with the right management teams and groups is key for them. And sometimes they'll utilize a private equity firm to help them with that. But a lot of times the private equity firms have limited knowledge and expertise in space, and so it's more or less the folks on this board or on this panel that give them that insight.
Well, that's a good segue. Let's talk about your experience with PE shops. Shaun?
Yeah, look, I mean, PE, let's just say that there's not necessarily that agile. Experience has really been that they need a lot of help up front just to get them comfortable with the sector and sub-segments, and they've got a real focus on downside protection down to either a scrap or a residual number. And the key thing is really just trying to understand, or have them understand, where any exposure lies in relation to the end of life of the asset after a fixed charter period. Now, trying to time the cycles in the market is extremely difficult. So these tend to be long-term investments. I think capital has always been available for the right types of investments and the right sectors. It's just really about time and getting the timing right. And that's really where they look to investment groups and investment managers to time that forward.
I think Shaun's got it just right, which is it does take PE firms a very long time to get invested, and that puts them at an extreme disadvantage, with regard to timing the opportunities. I mean, what we're most focused on is making sure that we can execute quickly in the market, have capital ready to go, and being the most certain and trusted buyer to any seller. So investing that time, as many of us have, with the PE firms and a full constituency of investors, so that money is ready, is what it's really all about.
Yeah, Bob, let me just ask you before you speak. What common mistakes have you see PE shops making, and what mistakes have you made in dealing with them?
I'll address the first one.
And before the second.
I think you guys are in the right direction. In our experience, the issue between PE and management teams is that PE does take time to figure things out because it's an industry that's a little bit off the beaten path. Once they do find out that they want to invest in the sector, there's a tendency for PE to want to control the deal. And the idea that they can react quickly, or the concept of reacting quickly for PE is very different than the concept of reacting quickly in the S&P market. And at this juncture, if it's not overcome, leaves the management team to be forced to buy a subpar asset, or force into new builds where the PE group can figure every last number, and they have assets that are brand new, heavy capital, a large fleet, because they put a lot of money to work, and it hasn't worked out generally. So what we have found is, to your point, Shaun, if that decision process, once PE figures out that they like the sector, is they want to get into shipping, is to push that decision process on the particular asset down to the management team. And then we can go out and compete with the Greeks and the Norwegians and anybody else who can react quickly. And we can buy a ship, in days or a week or two. Yeah. And that's very uncomfortable for a PE group to push that decision process down that far. But we have found that when we do the best deals, that's the relationship we developed, and it's the deep understanding of the asset class and the management team that leads to it. One more quick thing that I'll pass. It's difficult to talk to a new PE investor and say, you should really invest with us because you can trust us, because no one else in the industry is really trustworthy. Because then the reaction is, why do I want to be in that business? But it does, what it really means is you need to invest in the management team to understand, the management team that understands how our interests are aligned, and to make sure that those interests are aligned and they have a track record of following through on that alignment.
Yeah, I mean, I just to resonate that. I mean, for us, as we're new to the segment and sector, being outside shipping, I would like to say it's a little bit of an advantage because we're dispassionate. Our capital is not in shipping; it's not trapped in shipping. So we stand, shoulder to shoulder with PE investors, family offices, to believe in this opportunity. Because it is an industry that's had, a set of volatility over time, and I think Bob's got it just right. PE firms don't understand that, and it's very hard to get grounded, in the root of that volatility, how it works, and to make it predictable. So important, to get your capital locked up, and again, be standing in a line shoulder to shoulder with your investors.
We talked when we were talking, guys, the other day. You were talking a little bit about. Some of the investment structures that you think work better than others. And Shaun, you mentioned managed accounts and commingled vehicles. What is your respective experience with the types of structures that work?
Yeah, look, I think to address the separate managed accounts, we have investors where we're direct verticals, and we have investors that are pooled together within separate managed accounts. They're much easier to set up. There's very little regulation, so we can set up a company for them very quickly, and then bring in the assets underneath in separate various holdcos. Now, if you move then onto a investment fund or a fund vehicle, then the overhead of managing that type of investment structure is significantly more. They tend to be regulated. You have to do a whole bunch of background work around the sort of tax analysis for the different investors that come into the vehicle. And then you prospectus, lawyers, legal fees, etc. It all really starts to rack up. And it's typically raising a fund is going to be a 12-month adventure. Whereas a separate account, really, you get the investor on the hook, they want to invest, and you can set up very quickly, very nimble.
Jake? Yeah, I think the biggest issue is being able to transact quickly. When I see these structures that take 6 months to analyze, 3 months to paper, by the time you're done, markets have moved, opportunities have left. Owners are not waiting around for you to figure out your structure with your partners. The market moves is just much more fluid than that. And so having that and being able to transact when you get to market is just key.
I mean, one of the things that we did at Easter is we set this up as a FinCo, and we're funding it in tranches, so we're not going through the pain and suffering of Fund 1, Fund 2, Fund 3 in a way that is that causes that pause. So the ability to be fluid, is certainly to the advantage of an investor.
Darrell, let's just talk a little bit about Maritime Logistics Equity Partners, which you just set up. From your experience with that, I mean, what are the limited partners looking for from the fund sponsors?
I mean, the first thing that investors are looking for is their capital to be safe, and institutionalizing around an investment thesis is what we do. And what that means is providing lots of transparency, having trust, in the governance process, and allowing, making sure that we continue to be compliant with the expectations and the structure that we set up for our investors. In this, and then it is being a good investor. It's getting that money put to work quickly. It's eliminating the J curve. It's getting your ships put to work fast, and it's having the full infrastructure so that people know that you're a clear communicator, during the best of times and the worst of times.
So with Maritime Logistics, recent entry into the market, why now?
My sense, and I'd leave it to you, but it's my perception that this is probably one of the best times to be invested in what we've chosen as the chemical tanker space over the last couple decades. The supply is very low. We believe demand is going to increase, and that's the same kind of dynamic that builds a thesis in real estate, in shipping, in any cash flowing business. And so today, you look at the hard asset dynamic, which is inflation is on the way. And as a yield curve builds, having these assets with that growing value, in addition to the demand dynamic, we think is a terrific opportunity for investors.
Oh, you want to add to that?
Yeah, it's an interesting time in shipping. It always is. To attract new capital, we need to prove a track record from what we've done in the past, which is difficult sometimes when we look at the graphs. And for new investors, to go out and say that the order book is low, we're always asked what dynamic is going to change the market. How do I know that the market is going to take off in the predictable future? And we have a very efficient business, and everything is priced in. There's a lot of information, and it's commodity business at the end of the day. So the way we view these opportunities is we look at the asset price, we look at absolute value and relative value, and we look at optionality to the upside. And we know the dynamic is going to change, and the world changes constantly with surprises. So we want to position ourselves with an asset with the right age, with the right debt level, so that the optionality to the upside far outweighs the optionality to the downside. And what we find is ships over 10 years old seem to fit that pattern. Right now we have a different dynamic where propulsion systems are, what's going to happen, what's questionable over a 20-year period. Of course, we always look at the new build order book to make sure we're not going into a full storm. We look at supply and demand, and we think right now on the tanker side, with the pent-up demand, it's going to be a very interesting time over the next 2 years. The fleet is getting older. New ships are not coming in. New building prices are way up. Steel is more expensive. The container industry is soaking up all the capacity and a lot of the action in the room, and so is the bulker side. So we see an opportunity right now to buy these 10-year plus tankers. And the volatility in those assets to the upside is phenomenal.
What you mentioned before about alignment of interest between the investor and the asset managers, and I'm curious from your standpoint, what do investors require and what do the asset managers typically offer in order to align the respective interests in a meaningful way?
I mean, go ahead.
No. Well, just kind of quickly from our side, I mean, separate managed accounts, you tend to have an upfront fee. So we have to put the upfront fee into the deal as part of the equity, and then that's depending on the back end, and we get the returns, then we get paid. So it's really back-ended, obviously running management fees along the way. Then we're judged and rewarded on results, and that's pretty critical for us, the investors.
I was going to say, the skin in the game is important. The private equity funds are going to write big checks. They're looking to put money out. The management team needs to have some skin in the game. Otherwise, the alignment of incentives is just wrong. You end up in a long-only situation, and you want to be able to get in and out of your investments, and you want to have your management team incentivized to do so.
I agree with what they said, but not to repeat it again. I think one of the most important things that I've seen over the past 10 years is PE wants to be able to get out. And in our industry in particular, they depend upon the management team to get them out. And they got sick and tired over the past 10 years of deals that didn't find liquidity for ships that didn't get sold. So it's a really difficult thing for a management team who's getting fees. We all do it, make a living, to sell your assets, to rationalize. When the market's up, it's going to stay up. So I think a proven track record of providing liquidity to an investor who can't get it himself. It's not a chunk of real estate that he understands. He can sell it with Cushman Wakefield or somebody else. He doesn't want to fire us and hire some other guy to do the same thing. So it's an opaque industry to an investor base that is not used to investing in an opaque industry. So transparency and ability to get them out, I think, is really paramount.
What are investors? I mean, we're talking to four gentlemen here who represent tremendous investment teams and tremendous experience and knowledge. But what emphasis is placed on the team? Is it the team? Is it we're looking for large analytical teams, small teams? I mean, how do you guys approach it?
I mean, look, I think strong analysis is key. But at Easterly, for example, we partner with people with deep domain expertise, and it is about partnering with folks who have a deep understanding, cross-referencing, and making sure that we're getting capital put to work in a disciplined way that's consistent with the thesis. Investors, maybe most are familiar with this, but an investor is not necessarily looking to get the highest IRR all the time. The point is they want you to invest their money consistent with the thesis that's put forward. There's a fantastic thesis today around chemical tankers and getting money put to work in that disciplined way. Where so many folks have made mistakes over the years is that they take money based on a set of assumptions, getting buy-in from investors, and then they try to navigate that money in a little bit of a different way in order to maximize return and maximize carry. And the way you have enduring capital over time follow you and continue to invest in your ideas is just adhering to that discipline, providing transparency and being consistent.
So, getting the equity is obviously the hardest part, but once you've got it, you have to be able to manage it and maintain it. And what I've found is, investors, the one thing that they dislike the most is surprises. And so reporting becomes exponentially more important. And, what you report is coming, it needs to show up each month. And so there can't be surprises, kind of like every month you're showing X returns, but the cash flow doesn't quite match what you're reporting. And we all know why those things happen, but you need to smooth those out. And we've just, we actually just decided, the heck with it, we just created an app, 24/7 real-time reporting. This way there is no surprises, and when you do see markets come off, we actually show our forward fixing. And what it allows investors to do is be prepared, because they want to be able to, decide what they want to do with their dollars. And when they can get in and out and you have that level of transparency, it's going to make your life so much easier.
I agree with everything that was said. You need to be acutely aware that the guy who gave you money, it's not his money. He's got to report to somebody else. And he doesn't want surprises, or give surprises to his investors, whether it's on the financial side, the ESG side, anything. So that if you keep that in your mind, you'll be fine.
Yeah, just a final sort of point. I think that covers good news and bad news. To avoid the surprises, investors are really looking for a management team that has the depth in the asset class that they're working within, and to convey that within the reporting.
Yeah, bad things happen.
Yeah.
And we all know that. With the best assumption, the best intention, just tell me.
All of you guys are kind of also in the business of fundraising, right? So how do you approach, do you match fundraising to a deal? How does that work? Because you're all out there fundraising all the time.
I mean, I would say in this industry it's very hard to do deal by deal fundraising, just for all the timing issues that we've discussed. So you've got to get your capital organized and ready, and get a diversity of investors around the thesis.
Yeah, it's really the thesis, getting the thesis right, a base level of understanding on the underwrite, and really a strategy. If you're targeting midlife assets, exactly to Bob's point, 10 years or plus, that's you end up with a sweet spot where you can at least have some visibility to a downside, but obviously you're trying to work that to the upside.
I love that expression, getting the thesis right. What does that mean for you? What does that mean, getting the thesis right?
Well, you need to be able to invest in the thesis versus a transaction, because if you take a transaction and it's going to take you 3 to 6 months to raise the capital to do it, the owner's not going to be there. The ships will always be ships in the market to be bought and sold. What you need to do is execute on the thesis, show up in the market and be able to put those dollars to work.
And that can be sector agnostic, right? Whether it's tankers, container, dry or gas, it doesn't really matter. It's really more about the trade, the counterpart, the credit, and then what you think you're going to do with the asset at the back end.
One thing that Matt was curious about and is on this list of topics is sustainability, which I guess today means EFG, right? Or ESG. ESG is a strategy, right? It's a strategy that investors use to put money to work to advance good causes, right? I'm just curious, from the standpoint of environmental and social governance, what are your investors requiring of you, and what are you requiring of the companies that you acquire in terms of these strategies? Is it a deliverable? How does that work?
We address that in a number of different ways, but primarily the IMO set regulations for shipping. Shipping is one of the oldest, most regulated industries in the world. So if you think about the various connection points between class, the port state controls and others, it's very difficult to go too far on. You can't get away. It's so transparent now in the market, you can't get away with running a ship badly. So then the focus is on looking after the crew. I think we've heard earlier on around some of the challenges with COVID that have been going around recently, but the social piece will cover the crew, looking after the stevedores that we work on the ships. And then sort of governance piece then really is around the management team working with the investor and the other constituents that are organised around the trades.
I would suggest, though, that it's going to be very difficult if anybody out there wants to raise a fund that's ESG driven in this space, that it really is going to be hard to execute a thesis, because we're not going to be on the cover of ESG magazine. You look at
not in a good way.
And even just by definition of what is transported and what is the bulk of what we do, we should do it admirably. We should be cognizant, but a specific ESG strategy is probably going to be a failed strategy in this space.
You see the same thing, Bob?
It's a bit of a rearguard action. We all know the industry we're in, and especially we operate older assets, which are gonna be around for a long time. So it's a energy transition. And before you go from here to there, you sort of need the there set up. So in the meantime, we're here, and then it all has to be transported. So, one challenge is how do you convince investors that you're doing things with your older assets that really does improve what's happening today. Today as in, or tomorrow as in Friday, not tomorrow as in 2050. And there is a tomorrow that we're going to wake up to. We can improve how things work tomorrow, Friday, not 30 years from now. I think that's just as important, it's just as relevant. And it's actually something we can control if we work on it. And it doesn't pass the buck down the road to whoever's sitting in my seat 20 years from now. It's not an investable strategy usually, but it's certainly a program that can make current investors or future investors comfortable for the people that they have to report to.
Thank you, Bob. Gentlemen, we have just a little under 2 minutes left, and I was just wondering, is there anyone who has a question for any of these gentlemen that they would like to ask in the last 2 minutes?
You see a hand raised.
All right.
Hope we didn't bore everyone.
Any questions about the Blues Brothers?
Well,
Are you Dan or John?
Jake.
Jake. Joe. Yeah.
All right, gentlemen, then thank you all very much. Okay.
A late breaking question here from row 2.
Yeah, my name is Ralph Garn from. I'm sorry. My name is Ralph Garn from Scope. I'm from Europe, and I was wondering, in Europe, they are implementing now the EU taxonomy, and also specifically on shipping. And I've just read a report from Deloitte, and they have calculated the carbon, the impact on carbon revenues, on CapEx and on OpEx for a company. And I was wondering what you expect in the US to happen in the financing market on that. Like, will the finance companies have to at some point consider carbon calculations in their standard reporting to investors?
I would say not in the next 5 years. I mean, if you look at what's happening with the articles in Europe relative to investing, Europe is ahead on ESG regulation. I mean, and as John was sharing, I mean, I'm the chairman of a public company where ESG is very important, in our thesis. And so, as a new entrant, into this space and seeing how the structure of the industry is set and what we're doing, it's very, very hard for the structure to continue to incrementally be moved forward. And I would say that is going to, the importance of carbon emission is going to lead to dislocation of supply in this market over the next 5 to 10 years, which actually creates an investment opportunity as there's transition. And to Bob's very good point earlier, the industry is always in dislocation. One of the dislocations in shipping will be these ESG initiatives around the world.
So we actually offered to do the carbon offsets and buy the carbon credits. We have a 40-ship pool, 15 pool members. We offered it to all of our pool members and all of our charters. And it's not expensive. You know how many of them wanted it? 0. Because it just adds to the voyage cost in a market that's already depressed. Maybe that will change. I do ultimately think the carbon credit and buying the carbon offset, that market will get hot and it won't be as inexpensive as it is today. I mean, we have a 40-ship pool. It could cost us, I think the total cost was about $150 a day, and still no one wanted it. So.
Well, on that note.
I have a question for Shaun, if I may. Do you think, we've seen a movement, I would say, away from sort of private equity investment in shipping and more towards sort of investors putting capital in directly, as you've done at JP Morgan and now. Is that something that you think will continue to grow over time?
Yeah, look, I mean, the investors we're talking to currently, we have a broad range of groups which range from insurance companies, pension funds, ultra-high net worths, and family offices. So it's not PE in the traditional sense, but it's PE-like. I think it comes back to, the point we made earlier, there's a lot of money that wants to get put to work. Shipping, transportation is really an alternative investment class. It sits alongside real estate and infrastructure. It's a valuable asset, and it's physical. So if you're buying a shipping asset against real credit, you can match that credit against a bond, where you'll say a charge will trade with their bonds will trade, and you put your asset backed in with a physical asset. And you're probably earning more than the bond as well if you get the timing right. But yes, to answer the question, there's a lot of different types of investors that want to get into this market.
Yeah. Thank you.
All right, gentlemen, thank you very much. Bob, get the money to the municipal building to save the convent. I think we're done. Thanks very much, everybody.
Thank you.